Good afternoon, everyone. Myself Satyam Gupta. A very warm welcome to all the participants joining us today for this insightful webinar on foreign remittance, Form 145 and Form 146 under Income Tax Act 2025. First of all, I would like to express my sincere gratitude to our esteemed organizer, CA Dr. Raj Chawla sir, whose continuous effort in organizing such wonderful webinar. Professional learning initiatives are truly commendable. His dedication toward spreading awareness and updating professionals with the latest legal and tax development is highly appreciated. With this, I would request here Dr. Raj Chawla sir give the welcome address of today's speaker, CA Niranjan Srivastava sir.
Thank you, Satyam. Good afternoon, everyone. First of all, I welcome all of you in this today's
Yes, sir.
webinar on Form 145, 146. Earlier, this was 15 CACP. And today we have with us CA Niranjan Srivastava, our guest speaker on this international tax foreign remittance topic. So we will listen and understand how to fill these new forms as prescribed under the new Income Tax Act 2025. And friends, if you have any query during the presentation of our guest faculty, you can ask immediately. Otherwise, you can post your query in the uh, Q&A box or chat box. Our uh, Satyam will take up all of your queries after the deliberation of our guest faculty. So with this, thank you for joining. Happy learning. Thank you, Satyam.
Most welcome, sir. Today's key topic to be covered in this webinar: applicability, compliance requirement, and recent changes under the new Act. Form 145, detailed discussion on information required for payment to non-resident foreign company. Form 146, accountant certificate for payment to non-resident foreign company. Comparison of new forms 145 and 146 with earlier form 115CA and 15CB. Practical issues and challenges in foreign remittance compliance. Now, we are privileged to have with us our distinguished speaker, C. Niranjan Srivastava, sir, an accomplished professional with more than 17 years of experience in taxation, international taxation, FMI advisory, litigation, and compliance matter. His rich practical exposure and comment over the subject will certainly make today's session highly informative and insightful for all of us. With this, now I would request C. Niranjan Srivastava, sir, to take the session forward. Over to you, sir.
Thank you so much, Satyam, for your good introduction. And first of all, I would like to thank you, C.A. Raj Ala, sir, for giving this opportunity to present myself here. And I also welcome all the participants for joining this webinar. This webinar will be really insightful, and we will discuss a lot about the Form 145, 156. Right now, I am sharing the screens. Please confirm it's visible or not.
Yes, sir, visual.
It's visible.
Ji, sir.
My voice is also clear
Yes,
to
sir, clear.
everyone. Okay.
Ji.
So once again, welcome to you, every participants. And now we can start over the discussion on the foreign remittance form 145 and 146, which was earlier the name form 15CA and 15CB. This form is frequently used by the every professionals who are dealing in the cross-border transactions and making the remittance to the outside India. This form is not simply the transferring of the remittance only. This has the very crucial tax impact through this form. So department has a very crucial eye on the every transactions, and due to this reason, when the form is revised from the 15 CACB to form 146, 145, many changes has been also incorporated in these things, because the crucial matter is the tax point of view from the income tax department. And once the remittance is made outside India and it's get in the hand of the non-resident, it's a very difficult to collect the tax from that non-resident end. So for the ensuring the ease compliance and collecting the tax at the entry point of time, government has made this assurance through Form 145 and 146. So today we will discuss this term in the broad and details manner, like introduction and background of the Form 145 and 146 versus 15 CA and CV. What is the legal framework behind this form? Which kind of provisions, sections, rules is applicable, and through this govern these forms? Where is the applicability of the Form 145 and corresponding definitely 146? 146 is not directly implemented anywhere. Whenever the 145 requirement is came and applicability of the Part C is there, then 146 is the applied. Otherwise, Form 146 is not came into the picture. Comparison with the Form 15 CACB, what changes has been made? We'll broadly highlight these changes and what will be the what was the intention behind these changes and what will be the impact over that. Other compliance requirement and practical challenges which we face in the day-to-day practices. And after that, definitely we will in the question answer session over this. So tax deduction at source, often referred as a withholding tax also. Just a minute. So through the Form 145 and 146, government ensure the tax applicability, TDS, please. So tax deduction at source, often referred as the withholding tax also, a primary contributor to the India's direct tax collection. So this is the comes under the Income Tax Act and cover under the direct tax collections. Cross-border payment have always been a high-risk area for the tax leakages due to this reason, because once the remittance is made outside India, the remittance has crossed the border. It is very difficult to bring back the tax amount within the country. So in this time, the withholding tax is become very crucial. Withholding tax is a particularly critical for non-resident because they can easily move outside the jurisdiction of Indian authority, and Indian authority will face the difficulties to bring back and collect the taxes wherever the applicable, making recovery difficult if tax is not collected at the time of payment. Section 393 is specifically to monitor and secure tax on the payment made to the non-resident that are chargeable to tax in India. Earlier, the section was the 195, which was governed for the non-resident. In the new act, in the 2025, section 393, subsection 2 has replaced the section 195. And one table has been brought down there. And that table has broadly divided into 5 parts: A, B, C, D. A is the basically serial number. B is the talks about what is the nature of payment. Where it will be applicable, it's covered under the C, and what will be the rate in the covered under the D. So accordingly, section 393 has replaced the 195 section, and we have to look out there for the applicability of the tax on the non-resident person. Under the earlier regime of the Income Tax Act, compliance was ensured through the Form 15 CA, which was a self-declaration by the remitter, whatever the SAC has to file and give the declaration through the signing the Form 15 CA. Whenever the Form 15 CA Part C is applicable to file by the SAC, they have to get the certificate in form number 15 CB from the CA. Chartered accountant has to certify the Form 15 CB and ensure that the what will be the taxability of that remittance, what rate will be defined, and under which provision under the Income Tax Act or the under DTAA will be taxable and what rate will be prescribed. So accordingly, all the points has been verified and certified by the chartered accountant under the Form 15C. These forms were prescribed under the Section 195, TDS on the payment to non-resident, and Rule 37 BB of the Income Tax Rules 1962. The new Form 145 has replaced the Form 15CA and Form 146 has replaced the 15CB by introducing the Income Tax Act 2025. Section 392 has replaced the Section 195, TDS on payment to the non-resident, and Rule 222 of the Income Tax Act 2026 has replaced the Rule 37 BB of Income Tax Rules 1962. If we see the languages, then we will definitely identify some difference, but that doesn't change the interpretation. So languages has been definitely modified to interpreting the easily for the any person or tax professionals. But interpretation and implication has not changed broadly. If we compare from the Rule 37 BB to Rule 22, our Section 195 to the Section 393. Form 145, 146 should not be viewed as a mere procedural or transactional remittance form. This implication, as a real I said, this is not simply the form for the remittance. This is also a form for the collection of taxes. And when the collection of taxes and ensure the compliance has come, it's become the crucial. It serves as a critical assurance mechanism in the Indian withholding tax framework, unlike the earlier 15 CACB. So earlier 15 CACB was simply the when we look out the overall form, they only fill up the details about the remittance, remitter, remittee, what the form has been transferred, and what the tax rate has been applicable. Apart from that, there is no any details mentioned in that form 15 CACB about the who is the remittee, what is their identification number, where is the resident of that country or not. So this kind of things was not filled up in the Form 15 CACB, which has been brought changes through the Form 145, 146. 145, 146 are designed to ensure that payer has undertaken a comprehensive evaluation of taxability. Whenever the SSC or the professional who is filing the Form 145 or 146, they have to take the entire details and they have to ensure that if we are transferring the remittance to the any remittee, their identification number is already documented with us. Their residential status is already documented with us. Or if they are if they are claiming the benefit of the DTAA, then the proper documentation has been already submitted by them. So these all the things we have to ensure through the filing of the Form 145 and 146. This form act as a declaration cum certification that appropriate the due diligence has been exercised with respect to chargeability under the Income Tax Act, DTAA, and relevant judicial precedents. So sometimes, so our honorable Supreme Courts, our High Courts give some judgment which is not incorporated in the tax during the year in the Income Tax Act or even the treaty. But we have to take that consequences also. What will be the impact of that judicial pronouncement over these transactions? Like if you will see in the recent past, one decision has been given by our Honorable Supreme Court on the case name is the Tiger Global, which company is based on the Singapore. So this kind of judgment is also equally important when we are deciding the tax factor, when we are filing the Form 146. So once again, I will repeat, we are filing the 146. It's not the simply transferring of the remittance. We are deciding the tax implication on that remittance. So we have to examine entire remittance process very carefully. It implicitly requires the peer and the certifying professionals to assess the nature of income. The remittance is being transferred. That remittance is what kind of nature? Is this the business nature, or is for technical services, or it's a kinds of royalty nature, or it's a dividend or capital gain? So whatever the nature of that remittance, we need to determine. Secondly, determine the existence of the business connection or permanent establishments. So if any person is transferring the remittance from India to outside India, or any person is doing the business, first we have to check that income is accrue or arise in India or not. That is gone through the section 9 of the Income Tax Act. In that section 9(9) also talks about the business connections. And business connection have one part, the SCP, significant economic presence. So we have to examine entire things. If any uh, remittance is being transferred from India to outside India, or any entity who is paying to the outside India to any person for the regarding their any business transactions. So we have to examine and ensure that that transactions is covered under the nature of business or in the other nature like dividend, royalty, interest, like capital gain, etc. If it comes under the business nature, we have to establish that entity has business connection in India or not. And through ACP provision, significant economic presence, we have to also decide the any digital transactions if it's happening through the India and between the outside India. We have to also ensure and take the declaration from the foreign entity. They have the permanent establishment in India or not. P has the different kind of nature also. They have the sub-classification like agency P, permanent P, service P. So this kind of nature we have also to identify and ensure that this is being established or not. On that basis, only we can decide the what will be the nature of taxability and what rate will be applied. Apply correct tax rate and ensure proper withholding. Of course, after evaluation and establishing all the facts, we will correctly apply and decide the what will be the tax rate and what will be the actual withholding tax. The legal framework for withholding tax on non-resident is governed by the several interlinked provision of the Income Tax Act. Like Section 4, which establishes the basis of charge of the income. If any income is arising from the India, so first we have to check the sequentially. First, we have to check the Section 4, then Section 5, the scope of the total income based on the residential status. Residential status has been defined in the Section 6. So first we have to ensure and decide that that person is resident or not, because broad implication of the taxes is dependent on the residential status. So once the person uh, comes under the non-resident status, then totally taxability will be different. And once he becomes the resident, total tax implication and decision factor will be different. Section 9, which deals about the accrual and arising of the income. So this is the deeming section, and they have also deeming provision. So if any income is arising or accruing in India, or even deemed to accrue or arise in India, regardless of their the payment in physically made anywhere in the world, that income shall be also considered as a income arising from the India, and that will be subject to the tax. Section 393(2) which was the earlier section 195. This is talks about the taxability. This machinery provisions that mandate any person responsible for paying shall such income or some shall deduct income on the amount of such income or such chargeable to tax to a non-resident to deduct tax at the rate specified in column E. So as I said earlier, it was the plain section 195. In the section 393, they have given the tables with every subsection. So subsection 1 talks about the resident, and 393 subsection 2 talks about the non-resident. So they have given the broad table, and the table has divided into the 5 part A, B, C, D, E. So whatever the status has been rate has been prescribed is in the column number A. Column number A is the for serial number. Column number B is for nature of the business. Column number C is the for who is the person applicable over there, and column number E talks about the rates. So whatever the rate is prescribed, mainly two things is there. Either the fixed rate is given or the rate in force is mentioned in the column number E. So broadly, two things is mentioned in the column number E. So we have to see there and refer the tax rate from that angle. And if the rate in force is mentioned in the column number E, then we have to refer the respective section. Suppose as like in the case of the capital gain. So we have to refer that particular sections. It talks about the royalty and the FTS, is for technical services. So earlier it was the section 115A. Now it's a section 159. So we have to refer the section 159. The rate is also mentioned there. The rate is the 20%. Section 195 empower the central government to enter into double taxation avoidance agreement with the foreign entities or specified territories, which grant relief to the adopt more beneficial tax rate than the domestic rate. So earlier it was a section 90, which provide in the income tax 1961, which empower the central government. It's now replaced by the section 195, and here, through this section, central government has entered into the treaty with the foreign countries or specified territories, and accordingly, they have decided which nature of the income will be taxable at which rate, or which jurisdiction will have the right to tax this income. So accordingly, they have defined under the DTAA as per the article. They have given the different kind of article. First, they have to check their residential status, their permanent establishment, and then on that basis, we have to check the specific article. Suppose for the royalty and fees for technical services, Article 12 is there. For the different, their Article 10 is there. And the rate of the tax is already given in that particular article. So whatever the rate is mentioned in the income tax rate and the rate given in the DTAA, whichever will be more beneficial for the SSC, they can adopt. That gives power through that's benefit given through the DTAA. But they have definitely some conditions and restrictions to avail the benefit of the DTAA, which we will discuss later. Rule 220 prescribe the specified procedure for furnishing the information through Form 145 and 146 for the foreign employees. Earlier, this rule was referred as the 37BB. Now, under the income tax rule 2026, rule number 220 is replaced the rule 37BB of the rule income tax rule 1960. Here, it's a given the mandatory thing. Form 145 and 146 will be filed at the time of the remittance. When it will be applicable, its details has been given. Withholding tax rate mentioned under the section 393 should be increased by the applicable surcharge and the cess. So whenever the taxability comes under the Income Tax Act, the only simple rate wherever is given, it is not the final rate. So that rate, whenever we are going to apply, we have to increase that rate by the applicable surcharge and the cess. In case of the foreign company, if remittance is more than 1 crore, then surcharge will be 2%. And if the remittance, their income is the more than 10 crore, then surcharge will be the 5%. And accordingly, cess, the 4% will be applicable. So whenever we're deciding the tax rate as per Income Tax Act for the remittance, we have to increase that given tax rate under the Section 393 by the applicable surcharge and the cess. After including whatever the rate will become, that rate final will be applied over the pension. But in the DTAA, however, the withholding tax rate mentioned under the DTAA should be considered as a final rate, final tax rate, and should not be increased by the surcharge and the cess. As OECD model conventions uses the word all taxes imposed on the total income. So whenever we talks about the DTAA, the OECD comes in the picture. OECD stand on the Organization for Economic Cooperation and Development. It's a basically we can say the monitoring organization, and right now 38 active member is there. India is not the finally member of this organization, but India is actively participating and following whatever the recommendations given by the OECD. So we are the follower and we are the participant, but not the member of the OECD. So OECD is broadly adopted by the all over the world. Group India is the member of the G20, and G20 is also the part of the OECD, and all the finance minister of the G20 countries is also participating and contributing and following the OECD regulations. So here we recommended, we have taken this quotes, this phrase from the OECD Model Convention. All taxes imposed on the total income will be inclusive of the taxes. Whatever the rate is mentioned in the DTAA, that rate will not subject to the increase by the applicable surcharge and cess. Where under an agreement, the tax chargeable on only income is to be borne by the payer, then such income shall be increased by the rate of the tax. That means gross income. Many times when we are preparing the 15 CB and we are verifying the invoices and the agreement, the SSC also told and communicate to you. If this, whatever the amount has mentioned over the invoice, we have to pay directly to the remedy, and whatever the tax will be applicable will be borne by the us. So in this case, we have to gross up that amount. So whenever we calculate the taxes, whatever the TDS amount will be there, that will be the first we need to gross up by the that applicable tax rate to the invoice amount. After increasing that amount, once we increase the invoice amount by the applicable taxes, we will apply the tax rate over the invoice amount on the gross amount, and then actual the correct TDS amount will be come to the for the reporting. So gross of concept we need to the understand, and we need to the keep in the mind whenever we're preparing the form 146, because this the very uh, I can say frequent missing point, and whenever the mistakes is happen, this point is very frequent. So whenever the whenever we talk about the taxes, TDS, and the Income Tax Act, the PAN is the mandatory for the every person. So whenever we talks about the deductibility of the taxes at the source, the person who is receiving the amount, they have to produce the their PAN. They have to furnish their PAN. Accordingly, Section 397(2) earlier, which was Section 206(a). So this is mentioned irrespective of the any content in any other provision of the Act. Every person entitled to receive any amount on which tax is deductible or paying the any amount shall furnish the valid permanent account number to the person responsible for deducting or collecting the tax. If that person is not furnishing the PAN or they don't have the PAN number, so what will be the consequences? In case of failure of the comply with the provision of the clause A, tax shall be deducted at the higher rate of the following rate. At the rate specified in the relevant provision of the Act, or at the rate in force, our rate of the 5% of the tax is required to be deducted under, or the 20% or any other cases. So whenever we talk about the remittance, the non-resident comes in the picture, and person who is residing outside India, normally they don't have the PAN number. Then in this case, what will be the consequences here? So so we need to deduct the TDS at the higher rate if any non-resident person is not providing the PAN number at the time of transferring the remittance. So Section 397 said about the, Section 397 is definitely mandate about that. So Rule 217 has given some relaxation for the non-resident in the for the transaction of the certain cases, like the provision of Section 397(2) shall not apply to the non-resident being a or not being a company or a foreign company, where such deduction does not have a PAN in respect of payment in the nature of interest, royalty, fees for technical services, dividend, and payment on transfer of any capital asset. So these 5 transactions has been excluded from the PAN. So we have to note down that. Normally, we whenever we deals about at the time of remittance, we assume that non-resident has given the exemption for the entire transactions if they don't have the PAN. But here, if you will see, Rule 217 has given the only 5 nature of transactions, exemption for the 5 nature of transactions, which include the interest, royalty, FTS, dividend, and payment of the transfer of capital asset like capital gain. But if that person is not providing the PAN number, they have to furnish some other information. So Rule 217(2) has given these details. So here is mentioned that details and documents referred in subsection 1 shall be the following. If that person has to submit their name, email ID, and contact number, address in that country where he is a resident or specified territory, a certificate of his being resident in any country or a specified territory outside India. It simply talks about the tax residency certificates and tax identification number of the deductee in the country or specified territory of this residence. So tax identification number is similar to the our PAN number. Like we use the PAN in India, the TIN is in the foreign countries. So there that person has to furnish these 4 details. If they are not furnishing the PAN number, they don't have the PAN number. On that basis, they can get the exemption and they can save from the deduction of the higher tax rate. So whenever the transactions comes under the business nature, we have to check the significant economic presence. Nowadays, the cross-border transactions and digital transactions has become very common. And in this case, government has defined the significant economic presence. So whenever if they don't have the physical presence in India, they are transacting and making the transactions through the online. In this case also, it will be deemed as the significant. They have the significant economic presence in the India, as we earlier discussed. Section 9 has the deeming provisions. So ACP has defined as a significant economic presence. A non-resident shall have a significant economic presence in India where there is a transaction in presence of any goods, services, property carried out by such non-resident with or any person in India, including provision of download of data or software in India. If the aggregate payment arising from such transactions or transactions during the tax year exceed such amount as may be prescribed. So if that non-resident even do not have the presence in India, if, but their website is accessible in India, some people are buying the softwares, downloading the data from that website. And if that uh, if the payment against the downloading the data or buying the softwares is exceeding the prescribed amount, that non-resident will be considered as they have the significant economic presence in the India, and that will be subject to the tax. And second option they have also given systematic and continuous soliciting of the business activity or engaging in the interaction with such number of user in India as may be prescribed irrespective of whether the agreement for such transactions or activity is entered in India or non-resident has a resident or place of business in India or non-resident render any services to India. Suppose even they are not have the some goods, they are not dealing with the some goods or the services or the any other kind of properties. They are providing the some different kind of services. On that basis, if the certain number of subscribers have increased in the India, it will be considered as that non-resident has the significant economic presence in the India, and that will be the subject to the tax. So why this is important? Whenever we are making the payment, many times we got the invoices from our client. They simply say, "Sir, we have buy some software on the through the website, and we have to pay to that website only." So tax will not be applicable over here. We will see the few judgment of the Supreme Courts India or some high courts of the India. They have also talks about the non-applicability of the taxes. But whenever we look the separately in the isolation, definitely it will be not. But when we will segregate all the transactions, it's a cover under the business nature or in the different nature. So we have to look forward and combine all the transactions. First, we have to decide the nature. Accordingly, we have to decide the threshold, and then we have to decide the taxability. It will be applicable or not. Rule 13 of the Income Tax Act, Income Tax Rule 2026, have said that threshold for the purpose of significant economic presence, where in the section 99D, it's mentioned there, but threshold is not given there. So threshold has defined through the Rule 13 of the Income Tax Rule 2026. So they have given here the aggregate amount of the payment from the transaction carried out by the non-resident, any person in India, in respect of any goods, services, or property, including provision of the download of data or software in India during tax, shall be the 2 crore rupees. So you can easily imagine how big the 2 crore amount is there. It's not a significant amount, and it can be crossed over the very few transactions only every year. So if that website or that non-resident service provider has crossed this limit, they will cover under the significant economic presence And once he will cover under the significant economic presence, the business connection will be established. And once business connection will be established, that income will be taxable to the India. If they are not dealing in the goods or services, in this case, for the purpose of section 9DD2, the number of users with whom systematic and continuous business activity are solicited or who are engaged in the interaction shall be 3 lakhs. So if any person, any non-resident who is not dealing in the goods, services or property, but they have the subscriber of their website in the India, and that subscribers has increased the 3 lakhs, then they will be also covered under the significant economic burdens. And once the they will cover under the significant economic burdens, the business connection will be established. And once the business connection will be established, they will be subject to tax in the India. So these both the conditions we have to check whenever we are certifying the Form 146 in the nature of business. We have to ensure these things. Before that, one more things we also need to ensure whenever we're deciding the tax implication. So whenever we're referring the DTAA for the availing the benefit of the DTAA and taking the benefit of the reduce of the taxes, one concept is also common, the MLI, multi-level instrument. This is also the outcome of the OECD. OECD, as I earlier said, Organization for Economic Cooperation and the Development. They have the release Pillar 1 concept in the 2015. Under that concept, one document was came called the BAPS, BEPS, Base Erosion and Profit Shifting. Through this, multinational company was what doing there? They normally shifted their head office in the non-jurisdiction or non-taxable or less taxable jurisdiction, and they get the benefit of they enjoy the benefit of the taxes because as per the OECD, the taxability concept comes under the agency station. So they simply shift the head office in the lower or less or zero tax jurisdictions, and they become the agent of that country. So breaking that concept, the OECD comes with the solution that called the multi-level instrument concept. Through that, the tax treaty will be amended. So, whereas the multilateral convenes to implement tax treaty related measure to prevent the BAPS base erosion and profit shifting concept, it was happened in the signed by the India at the Paris, France on the 7th day of the June 17. So if any country where India has signed the DTAA and India has signed the MLI and that country has also signed the MLI, we have to check before the deciding the taxability under the DTAA. If both the country has signed the MLI document and they have agree on the any particular article like nature of business on the capital gain or dividend or interest, and they have given the even modification effect through the MLI, that will overrule the DTAA provision. Nowadays, if you will see the income tax department is also updating the DTAA called through the sensitized tax. And if you will access the income tax website, you can get there from also. They are updating all the MLI provision which has signed by the India with the different countries. So whenever you are referring the DTAA provision, you are deciding the tax implication, you have to refer the MLI provision also. Whereas the said convention entered into the force from the first day of the July 2018. So nowadays it's applicable and we have to refer this clause also. Whereas the date of entry into the force of the said convention for the India, the first day of the October 2009. So where is the applicability of the Form 145? Rule 221 of the Income Tax Rule 2026 is prescribed and applicability of the 145. The person responsible for paying a non-resident, not being a company or to a foreign company, any such chargeability under the Act shall furnish the following. So Form 145 has the four part, like Form 15CA, which has earlier under the Income Tax Act 1961. Of the Form 145, the amount of the payment of the aggregate of such payment as may be prescribed during the tax year does not exceed the 5 lakh. So on that given criteria, we have to select all the part A, B, C, and D, where it will be applicable. Part A, where it will be applicable, the part B. So according to the given criteria, we have to select this one. This form is a declaration form. It's a fill up and signed by the SSC itself. There is no role of the chartered accountant in this form. But many times we have to give the consultancy or help our client. So we have to give the control over this form. So part A, simply, it's similar to the Form 15CA part 1. There is no changes here. And whenever the remittance amount is the 5 lakh or less than 5 lakh, we have to file the form part A. Under the part B, if the any payment is aggregate of exceed the 5 lakh, whereas the certificate of the order is obtained from the assessing officer under section 395(1) or 2. In the simple term, it's the section 395, it's earlier was the 195 and 197, which talks about the lower tax deduction certificate, LTDC. So if any assessing officer has issued any lower tax rate of the certificate, and on that basis, we are making the remittance, then we have to file the part B. Part C, whenever is applicable, it's a two conditions there. One, the remittance amount should be excess of the 5 lakhs rupees, and that remittance amount is required to deduct the TDS. It should be certified by the chartered accountant. So that accountant, earlier it was the old act, Income Tax 1961. The accountant definition was given in the section 44. Here is the section. So whenever the accountant definition as defined in the section 5153 is obtained, but where information in part B of the said form has been furnished, no information is required to be furnished in the part C. So one thing we need to decide here, whenever we are filing the form, only one part will have to the fill up. We have to decide before the filing. Simultaneously, more than one part could not be filed. So either it will be filed the part B or either the part C. If we have the lower tax deduction certificate, on that basis, we have to file the part B. If there is no any lower tax deduction certificate and that remittance is exceeding the 5 lakhs rupees and subject to the tax in the India, then we have to file the form number part C of the form 145. If the TDS is not applicable, that remittance is not subject to the charge as per the income tax provision, then part D will be applicable and part D will be the fill up by the SSC. That is prescribed under the rule 220 sub rule 2. Rule 222 sub rule 3 defined about the no information shall be required to be furnished for any sum that is not chargeable to tax, irrespective of sub rule 2. If remittance is made by individual and it does not require prior approval of the Reserve Bank of India as per provision of section 5 of the foreign remittance, that reads with the Schedule 3. Basically, Section 5 of the FEMA talks about the current account transactions, and they have the given three schedules: Schedule 1, Schedule 2, Schedule 3. Schedule 1 is the restricted transaction. Schedule 1 has the permission with the central government, and Schedule 3 has the given to the permission with the RBI after some threshold. So if that nature of transactions is covered under this section Schedule 3 of the Section 5, even that amount is exceeding the threshold limit, we don't need to file the Form 145 or earlier Form 115C. The remittance is made by the unit of the International Financial Service Center. We normally called as the IFSC Center, which is situated in the gift city of the Gujarat. So if any unit which is set up under the IFSC Center, and if they are making the remittance from that location to the outside India, 15 Form 145 or earlier 15 CA will not be applicable. So here the total remittance is of nature specified in column number C is satisfied list. Total 33 nature of the transactions they have specified here. Out of which some I have given here illustrative list for you. Total list is the for 33 nature, and you can also access in the rule number 223 here. So if any remittance is made in the nature of Indian investment abroad in equity or capital share, in any investment abroad in the debt security, basically that is covered under the FDI, Indian investment abroad. That is covered under the FDI under the FEMA. So one compliance is being made under the FEMA. So here income tax under the Income Tax Act has given the some exemptions because it will be the really double compliance and there will be no meaning of that. Ultimately, the transaction is being controlled by the RBI under the FEMA Act. So due to this logic or intention, they have given some benefit here. So here, around 24 nature of transactions I have given here. Total 33 has been listed out under the section, under the rule 220. You can refer easily and you can get this list from there. Applicability of Form 146, as I said, 146 is only applicable in the Part C filed by the any remitter or SSC of the Form 145. If any remitter, any SSC is filing Part C of the Form 145, then only Form 146 is applicable. There is no separate requirement of the Form 146. So this form is also linked with the Form 145 Part C. Rule 221C of the Income Tax Rule 26. When information in Part C of the Form 145 is need to be reported, Form 146 shall be applicable. Conditions I'll already discussed. The amount should be aggregate of the payment exceed 5 lakhs. Such payment shall be subject to the withholding tax in the India. Certificate in 146 from the accountant is defined in the section 515.3. It's a definition of the accountant and chartered accountant. So that will be issued by the practicing chartered accountant in the form number 146. So if you will see the Form 146 at a glance, overall, Form 146 has divided into the 7 parts. First part is the particulars of the remedy. However, the sender details will be filled up in the first part. In the second part, the remedy details will be, recipient detail will be filled up. In the third part, the particular of remittance, but the fund transfer detail, which nature of fund, what amount in the foreign currency, what amount in the INR, what will be the taxability. So this kind of details, remittance detail will be filled up in the part 3. In the part 4, taxability will be decided as per the Income Tax Act without giving the effect of the DTAA. So without considering the DTAA, any relaxation, we have to first decide what will be the taxability as per the Income Tax Act 2025. In the part 5, we have to decide the taxability and tax amount on the basis of DTAA only. We no need to consider the Income Tax Act rate here. So both are the separate. You can say it's a comparative statement. So under the part 4, we have to give the taxability as per the Income Tax Act, and under the 5, we have to give the taxability as per the DTAA. So both will show the as a comparative statement. And under the 6, detail of tax deducted at source. So whatever the taxability will be decided under the 4 and 5, out of both, which will be the more beneficial to the SSC, it will be the comes under the 6, under the deductibility. So what will be the beneficial of the SSC? Definitely that will be finally deducted and will be mentioned in the part 6, detail of the tax deducted at source. And the last part is the verification part. The chartered accountant have to verify. They have to give the declaration. I have already checked and verified all the information which is correct in my opinion, and they have to verify the form 146. How to file the form 146? Step to be followed for the filing of the 146. First, you have to log into the income tax portal of the SSC with the valid ID and password. We can assign this task to the SSC itself if they are able to do it, or we can help to them to do it. Select the authorized person and click on the My CA, and then click on the Add CA and enter the membership number. First, we have to add the chartered accountant who is going to certify the form 146 through the SSC login. After successful adding the CA, assign the form 146 for tax year. As previous year and assessment year concept has been gone with the Income Tax Act 1961, now the tax year concept has been begun. So we have to select the tax year 26, 27 and onwards in the coming days. After successfully assigning the form, confirmation message will display on the screen. After that, logging the e-filing portal for the professional with the valid ID, which normally ID start with the ARCA and their membership number, and give the password. After that, click the e-filing income tax form and file income tax form. Through that steps, any person can file the 146. What is the basic changes in the form 145 and 146 versus 15CA and CB? So if we will talk about the form 145 and 146 under the Income Tax Act, it's governed under the rule 222 of the Income Tax Rule 2026, which was earlier under the Income Tax Act, Rule 37BB of the Income Tax Rule 1962. Form 146 has been divided into the 7 parts, clearly mentioned on the form. You can easily see the form. You can find all the parts has been separately. You can identify over the form itself. In the form 15CB was not divided, or simply serial number was the mentioned in the form. So it's a easy to identification and acknowledge if any error or mistakes is come. So which part has the mistakes, you can easily identify. Residential status of the remitter need to select it when you file and select the first option where you have to verify that portion of the first. You have to select the residential status of the remitter, which was not the earlier in the form 15CB. But now you have to select and assure that the remittance we are making the remittance, they are the resident or the non-resident. TIN of the remittee is mandatory. Earlier, it was not requirement under the 15 CB, but nowadays, whoever the person who is receiving the remittance, they have to provide the tax identification number similar to the PAN number of the India. In the other country, the tax identification number has been adopted by the foreign government. So you have to mandatory the fill up this uh, tax identification number. Principal place of business of the remittee to be reported. Earlier, it was not required to be reported in the form 15 CB, but now in the form 146, you have to also report the principal place of the business of the remittee. Many times it can be happen in the case of the other than company cases, that person is the agent of the other country. We are placing the TRC of the different country, but it might be possible that the place of business in the different places. Need to select the bank and authorized dealer are same or not. Earlier, it was not required in the form 15 CV, but now in the form 146, you have to select whether if you are making the remittance through that bank is the AD bank or not. So you have to select here also yes or no. So this changes has been come. So out of this, all the information you should have before you are going to file the form 146, because TIN number will be provided by the remittee. So you have to coordinate for that information through your client. Your client will communicate to the remittee and will collect this information. Residential status of the remitter, of course, you know the residential status of your client. Principal place of business of the remittee. In this case also, if you are making the remittance to other than the company, you should once confirm from the client and also it will be safer for you, which is the place of the business of the remittee. And through what bank the client, which bank your client is using, you can decide through this bank is the AD bank or not. So on that basis, you have to select the yes or no, this bank is AD bank or. Through the compliance requirement, Section 159(4), where the central government has entered into any agreement with the government of any country or a specified territory, in case may suppose one or a specified territory. So these sections basically talk about the whenever the some question has came to me, I will take all the questions in the end of the session. There is not an issue. So you can put in the chat box. I will take all the questions in the last of the session. So section 154 basically talks about the conditions if you are going to avail the benefit of the DTAA, if that tax is the more beneficial as compared to the income tax for the NESAC, then what will be the requirement of the section 159(8) has described here. NSAC not being a resident shall be entitled to claim any relief under the agreement mentioned in subsection 1 or 2 only when, this is the clear cut wording given here, only they can avail this DTAA benefit if they will satisfy the below conditions. What is the condition? A certificate of his being a resident in India in any country or a specified territory. अगर वो certificate, if they are providing that certificate of that resident country, simply in the term we called about the TRC. So tax residency certificate they have to produce, that is given by the resident of that country government. And second point, he provides such other document as information as may be prescribed. So is the other documents has been prescribed by the government? Yes, they have prescribed some other documents through the rules. So we have to ensure also, along with the TRC, TRC is already mentioned in itself in the section 159.8A, and some other documents which refer to the section 159.8B. So we have to refer the rules. So rule 75 has specified the other document and information to be provided for claiming the double taxation relief under the section 159.1.2. For the purpose of the claiming any double taxation relief under the agreement mechanism, they shall be as per the form 41. So earlier it was called the form 10F under the Income Tax Act in the Income Tax Rule 1962. In the Income Tax Rule 2026, the form 10F has been replaced by the form 41. So now, if any person, and second things, earlier it was not the mandatory in the Income Tax Act. If you have the TRC and the TRC has the required information mentioned in the TRC, then form 10F was the optional. If the required information was not mentioned in the TRC, then form 10F was the mandatory because that information was collected through the form 10F by the department. But here in the new act, in the 2025 and rule the 226, it is giving the mandatory effect. There is no option. You have to file the form 41 along with the TRC. So if we will combine all the whatever the documents will be required to claiming the benefit of the DTAA under the form 146, the tax residency certificate, form 41, no PE declaration certificate. The entity who is claiming the benefit under the DTAA, they have to give the declaration over their letterheads. They don't have any permanent establishment in the India. Copy of invoice and the copy of agreement. Definitely, you this kind of document you should have whenever you are signing the form 146 and giving the benefit of the DTAA. What is the practical challenges basically? So revision, withdrawal of the form. So there is no concept of the revision of the form. Only you can withdraw in case of any error within the 7 days of the submission of the form. So within this period, form can be withdrawn. So this is the practical challenges. Many times we make some errors or it's a typing mistake. So however, no option is provided for the revision. Many times professionals and taxpayers make the typing mistakes and etc. Along with this form, the UDN is also linked. So whenever we issue the form 146, we have to generate the UDN over there. Whenever we go for the withdrawal, then it's a challenge to withdraw the UDN also along with the form because we have the very restricted time to withdraw the UDN. Second challenge is the option for the grossing off. So many times when we issue the form 146, we forgot to check this box, this option, yes or no has been given under the form. This remittance has been grossed up or not. Whenever, because it's a direct, this gross up has a direct implication of the over the TDS amount. And whenever the tax evasion or tax deduction will be comes, department will be comes in the picture. So this implies that disclosure is to be made where the TDS is borne by the deductor or not. So this is the crucial, and we have to be very careful whenever we are selecting the option. We have to the recheck and double check the grossing of is being made or not, and what will be the implication of the TDS over this point. Penalty for the failure of the furnish or furnishing the incorrect information under Form 145. This is also the practical challenges. If any mistakes has been made, then penalty of the 1 lakh rupees on the such person will be imposed under section 462 of the Income Tax Act 2025. And if any mistakes or incorrect information is furnished by the chartered accountant practitioners under the form 146, then they will also be liable for the penalty of the 10,000 for any incorrect information, any report or certificate or rules made thereunder. And this penalty is applicable on the each such report or certificate. If you have mistake in the more than one report, then the penalty will be applicable for the each uh, for incorrect report or each misinformation. So this kind of implication and challenges we also have. So then we need to also be very careful. Should be the best practices for practitioners? So ensure robust compliance and professional should adopt the following practices. Use the professional skepticism. Do not rely solely on the SSC declaration for treaty benefit. Documents should be verified very carefully whenever the SSC or client is trying to convince or giving their the own interpretation. You no need to rely over there. You need to decide independently and you can decide accordingly. Obtain the key documentation before issuing the certificate. TRC, Form 41, no P declaration, and other relevant whatever the documents, invoice, agreement, copy, or if you think any other relevant document can be linked through this transactions, then you can also ask for that. So, and you also keep and preserve this document in your record for the future reference. Documentation for revision. If in case if you are withdrawing any form, all the documents, all the communication you should maintain and keep in your record for the future reference or why you withdraw this form and what mistake was there in the form. So it will help in the future for your reference. So now in the last we can see the question answer. I have created the two question for you. Is form 145 or 145, 146 required for fund transfer from NRO to NRE? It's a very common question and not very people asked normally. So I mentioned here. So the answer is yes. Even if you are transferring any NRI is transferring the form from fund from the NRO to NRE account, they have to the produce form 145 and 146 in the bank. Whether 145, 146 is applicable on the remittance made using corporate credit card many times, and nowadays it's a very frequently corporates and the corporate people are using whenever they go abroad for the visit. They uses the corporate card. They paid whatever the expense and liabilities outside India in the foreign country through the credit card. So when you go pay the remittance through the banking channel directly to the bank counter or bank website, they ask for the 15 form 145, 146. But whenever you paid the through credit card, they don't have the option to restrict the transactions on that time. But even after that, you need to maintain the form 145, 146 as per the law.
There is some noise for background.
So thank you. Complete from my side. And now we can take all the questions, whatever the option you solve.
So some question in the chat box from Rasi Jain ji. Say, what is the mandatory limit for this payment for data down?
For the data download, yes, it's a 2 crore. Whenever comes under the definition under the ACP. So whenever we're paying buying the any software or any other things, so first we need to decide the nature of transactions. This is the very crucial things. When we will decide the nature of transactions, only on that basis we can proceed. If the transaction is not in the nature of the business, it's a different kind of business. If they're different kind of nature, then we have to decide accordingly. But if you are buying something for the use of in our business as a software, definitely it will be covered under the as a nature of the business transactions. And once the cover under the business transactions, we have to check the ACP is being established or not. So if ACP is being established under the given threshold, it will be confirmed the your business connection in the India. And once the business connection is established, that amount is the subject to tax in India. So accordingly, we have to proceed.
The second question, ma'am, see here. So, have the purpose code also changed?
No, purpose code has not changed because purpose code has been prescribed by the RBI, Reserve Bank of the India. And Reserve Bank of India has not given the any changes. So income tax is income tax department has to only incorporate that the code recommended by the RBI. So there is no changes in the code.
सर अनिरुद्ध जी कुछ पूछना चाहते हैं आपसे वो
हाँ, definitely.
जी सर
नमस्कार साहब,
नमस्ते नमस्ते
मैं ये समझना चाह रहा हूँ,
जी
अगर कोई रिलेटिव अपने रिलेटिव को हेल्प करने के लिए यहाँ से पैसा देना चाहता है, भेजना चाहता है, उसके
जी
लिए क्या रिक्वायरमेंट है, क्या लिमिटेशंस है?
सर, ये जो क्वेश्चन है ना, ये फेमा के अंदर आता है। इसमें इनकम टैक्स का कोई रोल नहीं है। आप अपने रिलेटिव को देना चाहते हैं तो इनकम टैक्स में सिंपली गिफ्ट होगा,
जी।
और गिफ्ट के लिए कोई लिमिट्स नहीं है सर।
फाइनेंशियल हेल्प की कोई इसमें लिमिट नहीं आएगी?
इसमें तो कोई लिमिट नहीं आएगी सर। आप गिफ्ट जितना भी चाहे अपने रिलेटिव को दे सकते हैं। जब ट्रांजेक्शन क्रॉस बॉर्डर में होता है
जी।
तो ये इनकम टैक्स अगर एग्जेम्प्ट कर देता है तो फिर हमें फेमा के कंप्लायंस देखने होते हैं कि इट विल बी कंसीडर कवर अंडर द फेमा और नॉट, इज फेमा इज बीइंग अलाउड और इज बीइंग रिस्ट्रिक्टेड।
ओके।
तो ये फॉर्म की 145 146 जाएगा या नहीं जाएगा इनके क्वेश्चन के में?
क्या सर?
मेरे इस सवाल में जो
जी,
फॉर्म की जरूरत है पड़ेगी कि नहीं पड़ेगी?
फॉर्म की
जो फॉर्म है ये 145 या 146 की,
नहीं पड़ेगी सर, नहीं पड़ेगी, नहीं पड़ेगी।
मतलब डायरेक्टली बैंक से दे सकते हैं पैसा,
हाँ जी सर, दे सकते हैं, दे सकते हैं।
और कोई ना पैसे की लिमिट है और ना उसके अंदर इसकी जरूरत है इनकम टैक्स की। तो फेमा की रिक्वायरमेंट क्या होगी, ये फेमा से जाकर के देखूं
हाँ, फेमा से देख सकते हैं सर।
या आप यहाँ पे इस मंच पे कुछ बता सकते हैं?
हाँ, बता सकते हैं, बिल्कुल सर, कोई दिक्कत नहीं है। फेमा में भी है कि आप अपने रिलेटिव को गिफ्ट कर सकते हैं,
जी।
और रिलेटिव्स को जो भी गिफ्ट करते हैं उसमें कोई रिस्ट्रिक्शन नहीं है फेमा की तरफ से भी। बट उसमें जो एक लिमिटेशन है एलआरएस का,
वो क्या है?
एलआरएस में है कि आप ना एवरी ईयर इन ए फाइनेंशियल ईयर
जी।
अप टू 2,50,000 USD तक आप ट्रांसफर कर सकते हैं, उससे ज्यादा नहीं।
अच्छा,
हाँ जी,
तो उस लिमिट के अंदर अगर पैसा दिया जा रहा है तो कोई दिक्कत नहीं
कोई
आएगी।
दिक्कत नहीं है सर।
थैंक यू।
मोस्ट वेलकम सर।
The next question from Deepsika Jile. In case of overseas subscription for software like Adobe, where payment gets deducted from credit card of client and we get to know about in later, how do we file Form 145 in such case?
So of course you have to file the form 145 because you have already made the remittance, and if you will see the section, so this act is clearly defined that if any remittance is being made from India to outside India to the non-resident, you have to file the form 145 unless it is exempted. So in this transaction, there is no exemption. You have to just check the threshold. On the basis of threshold, you have to decide the which part of the form 145 will be filled up. So even the payment has been made through the credit card, after the making the payment, you have to file the form 145 and keep in your record for the future purposes. And it will be better to inform whoever person is being making the transfer or making the payment through the credit card. They have to inform you immediately, because you cannot file the form for the back date on the income tax portal. So it will be better to get information on the real time or within the prescribed time or proper time, and file the form 145 and keep in your record for your previous transactions. It might be a question from the your statutory auditor also, because they have to align with the whatever the provision given under the income tax act. Okay.
मैम आपकी वॉइस नहीं आ रही है आप also not coming.
Can it be filled in a month time? Ma'am, you can file any time. I am not restricting you, but you know also you cannot file this form in the back date. But what the provision says, whenever you are making the payment, you have to file the form. Means your form should be filed on or before the making the remittance. But in the making the transactions through the credit card, you don't have the real-time transaction, because the person sitting in the abroad, they are not informing before the making the payment to you. But even after the making the payment, he can inform to you. So within 1-2 days or whatever the time it's permit you, it will be better to generate the form, file the form, and keep in your record. So this will be better for future reference also.
Next question from Neha ji se hai. Is it mandatory for non-resident to file Form 41?
If that person is claiming the benefit of the DTAA, then it is mandatory. They have to file the Form 41. Otherwise, any person who is verifying the Form 146, any practicing chartered accountant, he will not verify that form. Or he will verify, he will not give the benefit of the DTAA. He will make the remittance taxable at the rate of whatever the given in the income tax act. So if they wanted to claim the benefit under the rate given in the DTAA, they have to file the Form 41. And even it's a responsibility of the CA also, and the professionals also collect the entire documents. I have already showed whatever the list of the documents should be getting from the client before verifying the remittance form.
Next question from Sir Sanjeev Gupta ji se. Generally, TRC number is not mandated in TRC of the deductee. How to file that number in Form 146?
So TRC number is not mandatory to file in the Form 146. TIN number is mandatory. TRC number is the different thing. That number is mentioned over the tax agency certificate. TIN is the different thing. TIN is like the similar or the PAN number. So you have to inform your client and collect the TIN number. And TIN number is mandatory to fill up in the Form 146, not the TRC number.
No,
You
sir,
may check,
actually
sir.
now it has made mandatory. TRC
Where,
number
sir?
also has to be mentioned in
Sir,
145. Sir. In form explicitly, both the number has to be mentioned. TIN
in
and TRC.
in the 145, na?
Yes.
Yes.
Earlier
In
it was not mandatory, but now it has made mandatory.
in 146, it's not mandatory till still. In the 146, you have to mention only the TIN number, but in 145, if TRC number is not mentioned, then we don't have the option. We can give the any dummy number, or you can mention the not available. That is our limitation, sir, because that country government is generating the TRC. We cannot say them, or we cannot question them to how you are not giving the TRC number. So just we have to accept and give the whatever the information is given in the TRC. So we can simply mention that there is no TRC number in the form, not available or something, whatever the system is accepting accordingly. I hope, yeah.
The next question from Kuldeep Singh ji se.
Yeah.
In case the RMT individual is residing in the tax-free zones like Dubai, will TRC of the can still apply?
Repeat my question. What is it?
In case the REMT individual is residing in the tax-free zone, will TRC or TIN still apply or not?
Yes, TRC will be applied.
Or TIN also applies, sir?
You can ask the directly, sir, any question?
Kuldeep sir, are you here?
Yeah. Yeah, my question is that see, Remedy is an individual and he is employed by company, working for the company, and but fully residing in the Dubai. We are paying him salary.
Okay.
Dubai is a tax-free zone.
Okay.
In Dubai, no such number is issued to the individual. So in that case, what can be the solution?
So of course, if he is claiming the benefit of the residence of any other country,
Yeah.
they have to submit the TRC of that country. On that basis only, they can take the benefit.
Okay, maybe there can be some other number, but TRC-TN is not applicable for individuals, and it is applicable for business entity.
So in this case, we have to check the that country, whatever the provision they have, their law of that country. But on what basis you will decide the residential status if they don't are issuing the tax residency certificate?
The person is having golden visa in Dubai.
No, visa is a different thing.
Yeah, yeah.
If person has the even visa, if he is residing there or not, it's not compulsory.
From tax point of view, he is also tax resident in Dubai itself.
So how you will deciding? How you are deciding this? He is the tax residence of the Dubai. On what basis?
Because
On the
earlier
basis of his passport?
so he is a British national basically, but he has shifted from England to Dubai, and he has filed a declaration in England that he is no more a England tax resident, and he has
Okay.
shifted his tax base to Dubai.
No, sir. As per my knowledge, I think TRC can be issued, and every government is issuing the tax agency certificate because it's a common practice all over the
Yeah.
world, and every person nowadays is moving from the one jurisdiction to the another jurisdiction. So if they will not produce the residential certificate, they will not be able to get the benefit from the any other country. So I
Maybe
think
there may be some other number, may not be TRC or TIN, but maybe there are other tax number which may be
of course,
available for
the
this.
it might be the format might be some different.
Yeah.
The name nomenclature might be some different, but they will ensure this guys is the resident of our country. On that basis, only the other jurisdiction government can grant the benefit.
Yeah. Thank you, sir.
Next question from Mahesi. In case a NRI has got his FDRs premature and redeemed his mutual fund in March 2026 and want his complete balance in NRO 2 US in April 2026, how to fill and file Form 145 of 146?
They have the fund in the NRO account.
जी sir.
They wanted to shift from the NRO to NRE.
NRI to NRO.
You can
here, sir, message directly आपको आता है. महेश सर आर यू हियर?
इधर देख ये एंट्री गेट है उससे ही इस बिल्डिंग के बैक साइड वो तो देखा हुआ है
I think not.
पहले तो
is not here.
No, sir.
Okay, no problem. I am just explaining. If any person has invested here in the India and money is redeemed from their investment to the NRO account and they wanted to shift from the NRO account to NRE account, they have to produce the Form 145 and 146. And in case of the NRI, there is also limitation under the FEMA Act of the $1 million. So beyond that, you cannot transfer in a single financial year. Within a financial year, Under the FEMA, it's a restriction of 1 million USD. You have to keep that threshold in mind, and you have to produce the Form 145 and 146 to transfer the fund from NRO to NRE account. It's okay. Next question we can take.
Yes, sir. Next question from Nehaji. Can we accept no PE which is not on letterhead but have company stamp on it with the legal tin number?
Yes, we can accept, no problem. We can convey them. Please, if you are mentioning, giving the entire information, if on letterhead, it will be more reliable document. If they don't have issued on over the letterhead, but they have given the stamp, they have given the proper sign, so there is no issue. We can accept. We can convey the message from the next year. Please issue over the letterhead. Okay.
जी सर. Next question from Saranjit Kaur ji say, in case of NRI children receive fund from India for purchase of property, then can it be exempt by filing this form?
Repeat the question, please.
In case of NRI children received funds from India for purchase of property, then can it be exempt by filing this form?
Yes, if they have received the fund from where? They have received the fund from India or outside India? In the
From
India.
India. From India.
So there is no transaction, cross-border transaction in this case. No? Person is NRI, but transaction is being made within the India from the one resident to with the non-resident. So if all the transaction is within the India, there is no concept of the remittance come here. So no 145, 146 will be required. Okay. Any question left?
Ji sir. Next question from Amit Gupta ji. If NRI transferred fund from NRO to NRE, bank always asks for Form 146, but no TDS is required. So what we do?
Yes, you have to file because bank doesn't know. You as a professional know what the income is taxable or not. If it is taxable, the tax has been paid to the authority or not. So you are the only genuine person or you are the correct person to know about that income, whatever the income has come under the deposited under the NRO account, that income is taxable in India or not. If that is taxable, the tax has been paid over that income or not. So bank doesn't know. So you have to certify in the Form 146 and on that basis, Form 145 will be filed and on that basis only bank will be transferred from the NRO to NRE account. So you have to file.
Neha ji, unmuting yourself and ask question directly with sir.
Hello. Hi.
Hello.
Sir, can we file Form 41 on behalf of the remittee here in India? Suppose I need to transfer funds to Spain to one of my representative. So can I file Form 41 on his behalf?
Yes, you can file, no problem. If you want to take the authority or
Okay.
if you want to represent on behalf of them, you can file. There is no restriction.
So उसमें जैसे लास्ट में आईपी नंबर वगैरह आता है, अगर वो इंडिया का आएगा तो कोई प्रॉब्लम तो नहीं है ना?
No problem, no problem, no problem.
Okay. And also sir, we also have some offices in abroad. So जो उनको salaries और expenses हम लोग transfer करते हैं उसके लिए भी Form 145, 146 mandatory है क्या?
नहीं, इसके लिए नहीं.
Okay.
That comes cover under the FEMA, not under the Income Tax Act.
Okay. ठीक है. Thank you sir. Thanks for.
Next question from Srikant ji say sir. These are applicable only when remitter is remitting income. 145, 146 के regarding बात कर रहे हैं सर.
Only, can you please repeat the question?
Only when remitter is remitting income.
One remitter.
नहीं सर. Only when remitter is remitting income.
अच्छा, when remitter is remitting income.
बस यही इतना लिख के
इतना ही क्वेश्चन है?
जी सर.
कंप्लीट क्वेश्चन है ये.
Srikant sir, are you here? I think not. I think so.
Okay, we can move the next question.
Yes, sir. Sometime non-resident entity mentioned its country registration RT instead of tax identification number as per TRC in Form 10F. Bill DTAA benefit to denied if TRC does not mention all the information required.
Yes. Earlier in the under the Income Tax Act 1961, Form 10F was required only to file when the TRC doesn't have the required information, like five kind of information: their TIN number, their address, the identification number, etc. This five information. If not mentioned in the TRC, then you have to file the Form 10F and give all the information through the Form 10F. If you are not providing this kind of information, then you will not get the benefit of the DTAA. In the Form 146, along with the TRC, the Form 41 is the mandatory. So even if you have the TRC, all the information is mentioned in the TRC, then also you have to file the Form 41. Only on that complete document, you will be eligible to get the benefit of the DTAA. Okay.
The next question from Neha ji. Can you file Form 41 on behalf of your MT?
Yes, I think this question is
I
completed.
have already got the answer. Thank you, Niranjan sir.
Sir, next question from Vinod Agrawal. Sir, please give the clarification on limit of 2 crores of data download regarding, sir.
So it's a limits of 2 crore is simply, sir, not whatever the transactions is being made from the India to that country against the providing their goods, services, and any capital transactions. So it will be covered under the, if you say, the turnover of the company, because this is not talking about any profit or any cost or any other things. So simply, if any person is providing the services or dealing in the goods, and if the payment is receiving from the India is exceeding the 2 crore limit. So in the simple interpretation, we can say it's talk about the simply turnover of the 2 crore. So if that is crossed, that company will be considered they have the significant economic presence in the India. And once they will qualify the significant economic presence in India, the business connection will be established. And as per the section 99, once the business connection is established, that income will be deemed to be accrue or arise in India, and that will be subject to the tax in India. So in the safer side, we have to deduct the tax, whatever the amount we are paying. If any website we are accessing or buying the goods or any services. So for the safer side, it will be better to deduct the tax and deposit to the government.
Sir, this is from C.S. Sunil Sharma ji se, sir. Ji. It is okay for a CA give a certificate in Form 146 if he is closely related, like sibling, to the person who needs the form.
Yes, there is no restrictions in the law. Any person you can certify. If you are giving the certificate not on the basis of your close or your relative or anything, you are giving the certificate only on the basis of the fact, and you are eligible to issue that certificate. So this is not the kind of opinion like audits, assurance, etc. So there is no restrictions as given. You can issue.
The next question from Suranjali ji se hai. Is Form 10A of 41 mandated to be filed electronically if non-resident is providing Form 10A as a self-declaration rather than filed electronically at income tax portal?
No, any offline form will not be valid. That is not acceptable. Only it should be filed through the online portal. and that acknowledgement number will be generated over the portal whenever you file. That will be the only valid form. Any self-declaration given by the any handwritten form or signed form, that is not the valid form, and that will never be accepted.
Okay. Next question from Deepsika. This is clarification here. So we are unable to file Form 145 after 4-5 trials. There was error after preview, form not getting filed, any portal related issue.
So it might be the technical glitches of the portal, because this portal has shifted from the old act to new act and all the new forms. But I will suggest, please delete the draft whichever you have saved over the portal, and start the new filing the form, because it once the glitches is saved in the form, it's a continued. So whenever you will continue through the resume the form and continue the form, it will be show the error, the same error. So it will be better to.
Should I try it again?
Yes.
I tried for the 3-4 times on the same day, but it could not be filed.
Yes, ma'am. I will request you, you please delete that saved form and start the fresh form. And after that, if you will again getting this kind of error, you can contact to the income tax department. There the helpline number.
Okay, sir. So I have
But
one
the
more query.
yeah, please.
My vendors are, if my client is paying like $3 payment to a vendor, so it will be compulsory to file form 145 in this case. Even $3 payment is going.
Yes, 145 is compulsory. There is no limit for the 145. Only limit threshold has given for the 146.
Okay.
So
Okay.
even if you are paying the even single dollar for the business transactions, or then you have to file the form part 1 of the form 145.
Okay, sir. Thank you so much.
Next question from Amit Gupta ji. If transaction amount is less than 2 crore, then what is the treatment? And if in the mid of the year, if exceed the limit, then we have to deduct the tax on exceeding amount or not.
So if the amount is not exceeding the 2 crore,
Okay.
the significant economic presence will not be established. Accordingly, that amount will not be taxable in the India. And once it's qualified the significant economic position condition, then the entire amount paid during the year, even before or after that transactions, you have to determine and the TDS over the entire amount.
Respected participant, if you have any question, please drop in chat box or directly communicate with sir.
I think our time has also been left.
Yes, sir. Yes, sir. I think not any queries, sir.
Okay, so we can conclude.
Yes, sir. Thank you all for being a part of today's enriching webinar on foreign remittance, Form 145 146 under Income Tax Act 2025. Our sincere gratitude to our esteemed speaker, CN Nirendra Kumar Srivastava, sir, for sharing his valuable insight, practical expertise, and professional guidance. Thank you once again for your gracious presence and active participation. Wishing you continuous success, growth, and learning ahead. Thank you to all.
Thank you everyone for your participation. Thank you you also for your good moderation, and thank you everyone.
Most welcome, sir. Thank you so much.